there's a lot of advantages from a tax perspective to owning REIT stocks and so forth. One of the things that we talk about a lot is no double taxation. Typically, C Corps will pay income tax and then subsequently they'll maybe make distributions or dividends after they've already paid taxes. So with REITs, they're not subject, or typically not subject to corporate income tax structure. So that's one of the big advantages. So no double taxation, meaning a C Corp tax and then you personally getting taxed. And then Daniel touched on this earlier, but the 90% rule, in order for REITs to not be taxable, they have to meet certain criteria, one of which is that for their taxable income, they are required by law to distribute at least 90% of their taxable income as dividends to shareholders, which is a big key and one of the reasons they're not subject to tax through the double taxation item I just spoke about earlier. Another really great benefit, and somewhat of a more recent benefit that came about through the Tax Cuts and Jobs Act, was this item called qualified business income deduction. And what that is it allows shareholders to actually deduct 20% of the ordinary REIT dividends. So instead of paying tax on 100% of the dividends, you're paying tax on 80% of the dividends. So you're already getting a 20% discount on your tax liability associated with REITs. And that doesn't have any restriction at the higher taxable income level. So it really provides a great benefit for those that are invested, especially if you have higher wage earners and so forth. And then lastly, capital gains treatment. There's ordinary income and then there's capital gains income. The capital gains tax rates is less than the ordinary income rates. So what real estate sales and sale of REIT stock are actually long-term capital gains treatment versus ordinary income treatment, which is also a tax savings because ordinary income could be, upwards to 38%. And then, capital gains treatment, depending on your situation, could be 0, 15, or 20%. So there again, you've got a discount of what you're actually paying from a liability perspective. And then if there are return of capital distributions, meaning amounts that you invested that are considered return of capital, those are actually tax-free. So there again, a lot of opportunities from a tax perspective that make REITs, as Daniel calls them, sexy, or real estate sexy.